Good morning, everybody. Thank you for joining us. It is Thursday, May 7th, for the weekly reminder of what day of the week we are on. Thank you for joining us. We are excited to bring today to you a special guest to help us explore what the latest and greatest is going on here. Today, we're going to be looking at the impact of the coronavirus on the financial markets and the economy. We are going to try to take a look at where do we go from here, and if you are an investor from financial standpoint and even from real estate standpoint, how to best operate so that you don't have as much impact as possible, minimize your impact from this if that's still possible. There's obviously been a lot of volatility so far. Today, we are very fortunate to be joined by Brian Mariash. Many of you who are our clients have already been introduced to Brian, or he's introduced you to us. We work with Brian and his team, Mariash Lowther Wealth Management at Merril, Lynch, with great frequency. He's got a laundry list of credentials taller than me that you can see on the screen. He's funny, he's engaging, he's brilliant, and he is philanthropic. So we feel extremely lucky to have Brian as a part of our strategic team of advisors. The biggest feather in his cap, I think, is that he's been named one of the top 3 financial advisors by Forbes magazine. So that's pretty fancy. And without further ado, I'd like to introduce Brian and welcome you, and give us a little bit of background.
Awesome, Joanne. Thank you so much. You hear me okay?
Yeah, absolutely.
Awesome. Well, I appreciate everyone taking the time today, and thank you, Joanne and Marina, so much for having me on. Certainly always appreciated our strategic partnership over the years, and of course our friendship as well. I think these events you're doing and these webinars have been amazing. I've heard nothing but positive feedback from a lot of clients and friends in town. So wonderful job you guys are doing.
Thank you.
I'll do my best not to derail it at this point.
Well, I know your theme or mission for your business is always educate, connect, contribute. So we just kind of stole one of your line items.
Allegedly, my attorney told me to always use
Yes,
that.
yeah. Don't you must have had a lawyer before.
Very cool. So I'm going to spend maybe 20-25 minutes just kind of running through what, some of this a lot of people know, maybe kind of shed a little different light on what's happened so far and how we got here. And then, of course, where might we be going and what we can do about it. Starting just kind of with the market and the economic reaction to the coronavirus outbreak when it first happened. If you want to skip ahead one, Joanne. First of all, I think it's important people realize it's a little different than a lot of the other crises we've been through. I've had about a 20-year career, so I started in the dot-com bust of 2000 to 2002, with 9/11, and then the corporate scandals, Enron, WorldCom, Martha Stewart, all of that stuff. Then 2008, the financial crisis. But this one really is kind of 3-tier, and it does make it a little different. History does not exactly repeat itself, but oftentimes it rhymes, as Mark Twain said. And so this is going to be very similar in some ways to other crises, but then also it's going to have some key differences. This is, all at the same time, we're facing both a health crisis. A lot of us, including myself, sitting in my home right now, right, doing this and been from a work at home posture for a long time. So there's concerns about actual health and hospitals, an economic crisis, which we'll, spend a lot of the time or the majority of the time speaking about today. And then that is different and kind of decoupled from the capital markets side of the crisis, right? So the real economy, people working, their jobs, their spending versus what is the stock markets and bond markets doing. The government and all of us have had to face with and deal kind of all 3 at the same time, and they all have different implications, and they obviously all play off each other as well. We go one more. One interesting thing, our Mariash Lowther Wealth Management is a boutique investment, financial planning firm, but we're underneath the broader umbrella not only of Merrill Lynch, but the even broader umbrella of Bank of America. This comes in pretty handy when it comes to our research. I wanted to throw this up here just as an example. I think 1 in 2 actually people in America are a client of our firm somehow, whether it be through U.S. Trust, Bank of America, Merril, Lynch, or we, touch somehow. So the credit card spending data that we have, about how much people spend and where they spend alone gives us kind of real-time information about how things are going. I just wanted to throw this up. There's a lot of numbers on there, but I think it shows a couple of things. One, that fall off the cliff, you can see right up the top, airlines, lodging, places we know, and all of a sudden we couldn't travel at all, or there's no way to leave the home. You saw things like cruise lines, hotels, and airlines just have fallen, just right off a cliff. But you can see when we talk about what to do now, there's other areas where actually spending is improving. So there's certainly been places to hide. Very, very helpful to have a lot of this kind of real data coming at us so that we understand what's happening. If you skip forward, I'll kind of do the recap. For starters, the market anticipated that the work at home posture was going to cause what I argue probably will be the deepest recession in history. We won't have that data yet. Recessions, a lot of these terms get thrown out a lot. So GDP, or basically how much money the country makes, that's reported on a quarterly basis, but in arrears. And a recession is defined as 2 consecutive quarters of negative GDP, which means we can't technically know that we're in a recession based on its definition until we've already been 2 quarters past that. And, March was the first month where this data just dropped off. So we're still really early in what I'm confident will be not only a recession, but a very, very deep, if not the deepest recession. And the market anticipating that crashed 35% literally in a matter of weeks. One of the fastest, like the third fastest decline like that in history. The word depression on top of recession gets thrown a lot. So I want to just kind of start by clarifying that, first of all, there's a technical definition of a depression, which is simply, 8 quarters, or excuse me, with the right exact number of quarters, but a prolonged period of quarters that's defined that is a depression when the economy contracts that much. But when everyone hears the word depression, they always think of the Great Depression. And those are 2 very, very different things. And essentially, most of what people are fearing of the Great Depression virtually can't really happen at this point. The things that caused that, besides just a huge run up ahead of it, which is nothing like what we saw here, and it was kind of unfettered by any of the rules we have now, like margin requirements. People could put $10,000 into back in 1929 and 28 and buy $100,000 worth of that stock and be very, very leveraged. Those things don't really exist. And then when the market crashed, if you had $10,000 in the bank, in Bank of America or JP Morgan, you very much could have and did lose that too. Banks failed. There was no FDIC insurance yet. So, it's just a very, very different environment compared to the much more protected environment we have now. 2008, the government did learn a lot of lessons. Ben Bernanke, who was the Fed chair in 2008, is the world's foremost authority on the Depression, which was pretty convenient to have at the time because of the programs they created at that point. Stopped us from actually going into one in 2008. And there was things like FDIC insurance, and they did the help that was needed. We were able to fire those out very, very quickly this time. So as that market was crashing, all of a sudden we started seeing stress in the capital markets, like in 2008. The Fed very, very quickly relaunched those programs and then some. And that, they're buying things like corporate bonds, like junk bonds, like municipal bonds. They're backing and backstopping money markets, basically stopping any of that liquidity crisis from happening. It was starting. It got reversed very quickly. It's not all the way back, and we'll touch on that at the end. And then we went to the more experimental things that we've heard about people talking for years, and now it's actually happening. So the idea is that this should be temporary. And, there's a lot of different ways what the new normal will look like. But if everyone has to go home and everything just stops overnight, in 2, 3, 4 months, pick what it is, eventually people will go back out. What the government sees their obligation to do, and most economists, and I would agree with, is to stop a chain reaction from happening so that when all of a sudden someone loses their job, they no longer have the cash flow to pay their bills. They can't pay their landlord. They can't pay their cell phone. And so all of a sudden, landlords and cell phone companies start going bankrupt, and then they can't pay their bills. So they lay off their people, and then those people can't pay their bills. And it just creates this chain reaction. And that's what happened in the Depression. The government wasn't able to paper over or kind of stop that chain reaction. So helicopter money is kind of the nickname for the strategy of what do you do when we go into a deflationary or demand shock to a depression or recession. And the answer was to fly helicopters over and just drop money, being the metaphor. But when we saw the CARES Act pass, which I know Joanna and Marina spoke a lot about on those programs are really part of economic theory, that you have to just get the money back into the hands of the consumer Consumer spending is the vast majority of our economy. And as long as you give them enough to hold them over during this period, then the chain reaction doesn't kick in. And then pent up demand, because everyone's staying home, ready to eat out and do things again, eventually ready to travel again, all of a sudden that will flood back in and fuel the recovery when it happens. So the government's done those programs. They've been fairly effective, but honestly, there's a lot of logistical challenges. So it's the right play. The question is just, one of the big risks that we'll talk about and where do we go from here is, are they actually able to get the money into the people's hands, whether it be through filing unemployment, through PPP loans, through the $1,200 type programs? If people don't actually get the money because of a logistical challenge, then it might not work. And that's kind of one of our risks of what could go wrong. After that big 35% drop in all the government programs, the market is now anticipated recovery, and we've seen a very, very big bounce. Last month was one of the best months. It's probably the best month in the market in the past 30, 40 years. I think I'll throw a chart up a little bit later showing what that means, but we're very, very cautious about big bounces like this. Still believe we're in a bear market, and still most likely, one of our base cases is that, we're not quite done yet with this. There's going to be a lot of kind of fits and starts for a while. So 3 possible scenarios. I mean, we could break these do break down to many more, but I think a lot of people are always like, are we recovering and why? Are we going down further and why? We don't have the answer. Hopefully everyone didn't dial in for like the crystal ball where it said, this is what's going to happen. What we do is
next Tuesday, we'll have Miss Cleo on.
Perfect. Yeah,
yes.
Yeah, if I did have the crystal ball, I'm still taking the time to do webinars, be an amazing community service person, obviously. But what we do and what we do on behalf of clients and work with clients to do is to say, what are the scenarios, and then what probability are they going to happen, and then how are we positioned for all of them? Because someone hires, a financial advisor, what we're being tasked to do is to make sure that regardless of which scenario happens, you still need to achieve your goal, whether it's retirement income or still making it on track to retirement, putting kids through college. We can't let these things derail it. Theoretically, they shouldn't have if you were planning properly. We're an 11, 12-year expansion. So the risk of recession was always heightening just simply by time and extension. And markets crash at least 30% on average during recessions. So there was nothing shocking actually about what's happened. It's how it happened and all the other aspects of it. But from an investment portfolio standpoint, theoretically, you should have been somewhat positioned for the fact that recessions happen. Stock markets drop a lot in recessions. And therefore, the amount of money you have in the stock market should have been and still should be the long-term bucket of the portfolio, meaning you don't need that money for 7 to 10 years at least if you're investing in stocks, right? So if someone gives you $100,000 and they say I need to buy a down payment for a home in 12 months, that money should not be invested in stocks because there's just too many things that can go wrong in a 1-year period. But if that's to help combat inflation and have retirement money for 10 years from now, then a portion can be. If you flip to the next slide, Joanne. Another really cool part of that credit card spending is we're now watching state by state, sector by sector, how opening up is working, right? So we're seeing this happen way, way more than you would see. Like if you just watch television, you hear people's opinions. Like this is just one example in Georgia, I think with beauty salons. I think pretty cool that we can kind of see, is it working, is it not? Are they spending, we can see the increase in upticks in spending, but how does it look like before the crisis this time last year? We can start seeing how different states' plans are working or not working to try to figure out which scenario actually plays out. If we move on one more. The 3 core scenarios we're looking at from a market standpoint are either one, our base case, that we're going to retest the lows that we set in March. That's quite a fall from here, by the way. So anyone that's either overweight or had too much in equity still have a great chance to start de-risking at this point, because if it's the wrong amount, you had a great bounce to try to de-risk, but most likely the base case still is to retest. Our second most likely case is that we actually take those out and make new lows. Not comforting for people, but it's just important to recognize that when the stock market goes into a deep recession, meaning deeper than average, then the market tends to reduce peak to trough from the top to the bottom 50% on average. We did that in 2008. We did that in 2000 and 2002, which by the way was actually a very shallow recession in 2001. It still got a 50% retracement. 1987 crash, of course, everyone would probably remember or be familiar with. I mean, to only get a 35% drop on this type of recession with all of the uncertainty that we're seeing is not very likely. So we're prepared for those new lows as well as kind of our second most likely case. And then the least likely case, the one that obviously everyone would want for in the investing world in the short run, was that we just never revisit those lows. We just keep grinding higher from here and everything just goes back to normal or a new normal and everything's good. I'm not willing to bet my money. I'm not willing to bet clients' money. I'm not even willing to bet people that I don't like's money on that scenario too heavily. However, we still have to be ready for it, right? So, because we don't know. So it's not like, this is why you don't just sell everything. If you're like, why don't you sell everything? Because if people did sell everything in March, we know, because the volumes of mutual fund transactions, which is what most individuals own, and the volumes in general were at their all-time highs at the lowest points of the market as everyone was panicking. So a lot of people sold because they figured they could get back in, and then the market has the best month in 30, 40 years, and now they're trying to get back in. And then eventually it'll drop down, you'll see panic. It's just that greed and fear. This is just part of the bottoming in process. It happens every recession. We could talk about why it's different, but the truth is this is just how it happens. It's greed and fear. It's shaking all these people out until it finds its level, and then it'll resume its recovery. I think it's really important. You've started to hear it more now. I mean, I was talking about this, as Joanne Marina know, on my calls with clients. You're going to start hearing a lot about what type of bottoms we're going to make in the economy, right? V bottom, L bottom, W, and then maybe a U. These are just the shape that are described as letter. I've only been through V bottoms. Most of everyone on this call has only been through V recoveries, right? 2008, furious, scary. The whole financial system is going to go down. Government bailout happens. We start this recovery and we never look back. L is like Japan, right? 1990, 91, their real estate market and stock markets peak. They've never returned to those peaks. They've been in a very long, drawn out L-shaped recovery for decades as they combat deflation and aging population. W would be like in the 70s, where you have this double dip, right? Where you have a big drop, you have some recovery, and then we go back into recession again. Probably my base case is that there's a lot of risk of W's, or a W scenario for a while, because we don't know about flare-ups. We don't know about if reopening works or not. So we're going to see, and we also don't know psychology of people changing, right? One thing you can see from that data I showed earlier is credit card bills, if you haven't looked at yours, are probably lower than they've been in a long time. If you're staying at home for a long time, your spending patterns are changing. And after 30, 45 days, right, your habits are now forming. You're going to start realizing what you can live with and without, and it's going to change consumerism to some degree and how people spend. So the other real important thing to think about where we go from here is, even if we bottomed already, or if we retest the low and then make a bottom in a couple months or in the next month, that doesn't mean that your investments are just going to smooth sail in a V recovery for the next 5-10 years like they normally do. There's a lot of scenarios where we're going to have more of this W or even a U, a long drawn out one. If you want to go next, Joanne. Mm-hmm. A lot of data on there, but the idea is just to remind people that the fact that the market was up 30% is amazing, but it is not a sign of a bull market. It's a sign of a bear market typically, right? And this is just the data of all the other movements that are similar. This is the third strongest one we've seen. Almost all of them are occurring during really bad times with more bad times to come. So it's more consistent with like a bad thing than a good thing. For those not as familiar with bull market, bear market, bull market is when the market is going up, like we had been doing for about 11 years, named after bulls, the way they attack with their horns, they attack in an upward fashion. Bear market, which we are now in, is bears attack down with their claws. So we're now in a downward moving market. Even though we see these big, huge rallies, it's still an indication typically of a down market, not an up market for a while. Next slide, please. So what can you do to protect yourself now, right? So we talked about really bad thing happened. Government's doing the right thing, starting to work for sure, but it's going to take time and there's a lot of risk. So what do you do going forward? If you flip one more forward, Joanne. So for starters, review the plan you have or have a plan, because not everyone does, right? So every client of ours, one of the first part of their onboarding is, assessing goals, whether it's saving for retirement, saving for a goal like college, or if it's already retired and trying to have a certain amount of income and a certain amount left at the end. Every client should have a certain percentage of their liquidity, of their investments in equities, and it's different based on that goal. This is a lot easier to handle if you have that plan, right? If you're supposed to be 50% in equities, because that's going to get you to your goal, it's giving you the highest probability to get there. When the market crashes, all of a sudden you're 42% in equities. It doesn't matter what you think about stay-at-home policies or anything like else. It's just we know that you're underweight equities and that you need to rebalance, and you start buying. You know, we were able to buy when the market dropped down 20 and then down 30. Those little rebalances, as long as you had a plan in place to do the rebalancing, it drove the decision of how much to buy and when. So we didn't have to really figure out the predicting part. And then, of course, when this market snapped back, you end up with some nice gains as a result, and we'll continue doing that for some time. The other issue is that if this does take longer or get a lot worse, you really, really, really want to own quality. And at the end of the deck, I think I'll just show some examples of where we build portfolios from these days. But quality means you want a company that has no debt or low debt ratios and dividend paying that they can cover, so that you're going to get cash flow while you wait, and be in industries that we know are outside of the spotlight, right? I say know what you own because I've been a huge index fund ETF person my whole career, but both in 2008 and now, you don't want to own everything because if you own everything, it means you own the cruise lines, the energy pipeline companies, some of these energy oil companies. There's going to be bankruptcies, massive dividend destruction, that's going to happen. So you really want to own the spaces that are going to be fine regardless, so that if this keeps getting worse or we go back and forth between worse, if you own Google and Apple and Johnson & Johnson and McDonald's and Procter & Gamble, if you own these companies that are producing the things that we need right now for stay at home, right? So like Zoom that you're on right now, or WebEx, companies like Netflix, Amazon, as everyone's ordering from home. It wasn't that hard during this to figure out which plays people would still be using, especially since we have that data, and then getting out of all the problem areas quickly. So being in this huge balance, it's starting to roll over. If you simply take the opportunity to shift out of the everything kind of portfolios and get focused into the names that you can hold through this, have the right amount of stock, and then have the right kinds of stock, and then consider for those qualified, and there are some minimum levels for different types of alternative investments, but just some examples, like our long short funds, they're up like 10, 12% for the year, but they were down 1% at the worst of this when the market's down 35, and private equity and even commercial real estate in the right sectors, right? Like, so commercial real estate, if you're owning, retail, can be very challenging, right? It was probably going to get a lot more. Office space, I don't know that I'm ready to go back to my office anytime soon, and I'm pretty sure my firm knows that. I'm sure they would rather save a lot of money by not having all these big offices when a lot of people really can work from home. I saw Nationwide announce they're closing 5 entire of their buildings for everyone to work home permanently and just keeping their headquarters, just as an example. We're going to see a lot of that. But if you're in industrial space, where we were already having kind of a renaissance with some of the trade issues going on, expect to have some major regulation about where we make medicine and where we make different things. Huge boom for industrial type commercial real estate in the United States. Also apartments, there's areas to stay away from the problem areas, but those, like that alternative portfolio that we're looking at, is actually up the whole time, right? I mean, some of them are down a little, some of them are up quite a bit, but like if you add something that's not just stocks and bonds, then you can actually increase your chance of not drawing down as much when things are down. So really important to include alternative investments, rebalancing strategies like we spoke about. I mean, I'll just share our core strategies. If the market gets down to the low and we're supposed to then buy equity, we don't buy it all right then. If it retests the low, we'll put a third of what the gap is. And then if it drops to negative 40% peak to trough, you put the second third. If it gets to 50, which is about as bad as the markets ever historically get, you put that last third in then, so that you're not like just putting, everything in at the wrong time. So you have to have a defined strategy and be very, very technical about it. Be very careful with fixed income. Bonds are things people don't understand as well. There's been bloodshed in the bond market if you were in the wrong part. Our treasury bond portfolios up 10, 15% for the year. Great hedge against stocks. But some people that have high yield bonds or junk bonds or floating rate bonds or CMBS type bonds, they could be down anywhere from 10 to 30 or 40% in what's supposed to be their safe money. So be really, really careful there. Make sure you have your fixed income analyzed correctly. And lastly, be flexible and be ready to change. Right now, our models are based on everything we have in data, which is changing a lot as we find more and more out. If something fundamentally changes, we will alter strategy at that point. So you have to be flexible enough to do that and not be in anything that's too dug in. I'm going to flip one more, Joanne. I'm not going to go obviously all the names, but researching what companies, it doesn't matter if this lasts for 2 years that stay at home, they still have so much cash and they're still earning money that they're going to be fine. You don't have to lose sleep. You won't panic out and sell a company like that. This is kind of 55 of the names that we built within the first week of this crisis to say, here are the stocks that we're going to select from for portfolio management. Fortunately, those portfolios did very, very well while the market fell compared to the market, and have actually kept up or outpaced even to the upside. These trends are going to be in place for a while, and these are companies that you can feel good owning when the market's down, but also know that you're going to participate when the market's up. Want to flip one more? All right. Did speak quickly. Joanne and I get along for many reasons. We'll include our Northeastern roots, perhaps. I don't know, Joanne, if you want me to, if I hit on anything else any differently or recover anything, or if we just want to go straight to audience Q&A, or you and Marina, just let me know.
One thing I'd like to touch on is your comment specifically with respect to industrial space and the commercial real estate market. One thing that we've heard a lot inside our law practice is, of course, we do real estate closings, and a lot of folks were concerned primarily with the residential market. We haven't really seen so much tumultuous result in the residential market. There's been a little bit of shrinkage, but we've also seen some interesting concepts where, you know, less listings are coming online because sellers are uncomfortable about people being in their homes physically. But buyers seem to have been really resilient and have adapted well to virtual showings and 3D tours of the properties. So on the residential side, we've actually seen where the supply is shrinking and the demand is smaller, but it didn't shrink with the same proportion as the supply. So we're actually seeing prices a little bit holding steady. I was on a webinar with the Florida Realtors and the National Association of Realtors in conjunction with our local Realtor Association of Sarasota Manatee, and they were suggesting that we might actually experience a small uptick in pricing because of the shrinkage of supply. What my concern really is, and I'm interested in your thoughts, is with respect to commercial real estate, because obviously you're going to see some retail vacancies, possibly some restaurant vacancies locally and on a bigger scale. But that industrial space, particularly locally, has had, you know, not a great run the last couple of years, and it'll be interesting to see how Sarasota, from the EDC standpoint, and Manatee have both been very aggressively trying to pursue companies to bring manufacturing and light manufacturing, computerized technology type manufacturing here. So it'll be interesting to see that play locally in our market. But with respect to some of the real estate portfolios that you guys manage in terms of REITs and other things, what are you expecting to see unfold here?
Sure.
Crystal ball, please.
So I think a lot of the trends were already in place. They're just really slow moving, right? So industrial versus like retail and malls, you know, had been in booms for years. And then obviously that decline has been starting with online and technology. Mm-hmm. Industrial has the same, the reverse benefit, right? The fact that a US company, even though it might be cheaper to do business overseas with their manufacturing, they could bring that back. And because of robotics and because of automation, they have a huge incentive to buy industrial real estate here and move their stuff back. It's just expensive to do that. Mm-hmm. The current administration was starting to accelerate that process with the trade war. And so I think that was pushing companies to do really what they actually wanted to do anyway, because it's actually going to be cheaper for them to do it here than the way they've been doing it. This is just going to take that to an even faster pace. I think it was starting. I'm not as knowledgeable of the local industrial base as you would be, Joanne, with closings, but like nationally, that's been a pretty strong area for us to invest in. And then there's a lot of like, you know, when we invest in commercial real estate, sometimes it's things like industrial, sometimes it's things like, and these, again, this is through private real estate investments and or REITs, but mostly private real estate that we do for clients. It's industrial. It's these apartment complexes. We do see those in Sarasota, right? You go down Fruitville, right? You know, right past your office, you see those huge things. Those are great investments demographically. But then it's things you don't always think about. You know, Digital Realty is one of our core REIT holdings. You know, it's server farms. It's, you know, big buildings full of computer servers that are basically renting that space out based on traffic, which is skyrocketing, right? You know, so that's a stock I don't think it ever went down on us the whole entire time during this. You know, trading at all-time highs regularly. You know, so there's real estate plays within the growth in IT and cloud, as well as in traditional industrial space and apartment. And that's kind of where we focus there. I think the residential, you know, there's a lag on all of this. The stock market's fast and furious and liquid. real estate takes time. You're still working out your pipeline and your closings. And then for a while, I think when I spoke to a lot of realtors anecdotally, like nothing was happening because it was pretty freaky there. But then it kind of like cooled off and loosened, and people are starting to do showings again. Some people still have to buy, right? They still have to move here for tax purposes, or they're moving here for a relo, or they're moving for work, or hopefully those of us with millennial children, they're moving out and moving into their own homes. So some of that's still going to happen no matter what, but the discretionary stuff gets a little nerve-wracking, because I don't necessarily need a second or a third home, and we do have a lot of that in our local market. As long as I think the stock market actually does drive a lot of that. If people feel good about their portfolio liquidity and net worth moving forward in their businesses, which of course the stock market's reflecting the health of the businesses, then they continue to buy. And I think we do fine. I should have been expecting softness anyway. Like I said, with the stock market, we should expect, if not a recession, slowdowns. And in the real estate market, same thing, huge expansion off that 08. So a lot of what we're seeing, if you take all the noise out of it, should be how people were kind of positioning for anyway. The bigger question is just, does it get prolonged, and does it be up and down, and how have behaviors changed and psychology's changed about some of these things? And, there's, other wind in the sails for real estate. The mortgage rates have not come down nearly as much as they theoretically should, right? If you look at where the 10-year treasury is, they got down to like 0.5%, trading at, 0.6, 0.7, wherever we are today. And the mortgage rates, you would expect a spread that would be a lot lower. If you should at some point could see, 2%. I've done loans, as you know, Joanne, for your clients, 1.75 for 5 years and things like that for real estate deals. Like, that's very cheap money. That is also some wind in the sails. Interest rates theoretically can get negative, as a next alternative. It's not unrealistic. I think people have a hard time getting their head around that. I'm going to buy $1 million house, and in my mortgage, they're going to send me $2,000 a month. It seems pretty ridiculous. But that's what a negative interest rate is. We're not going to see it in mortgages most likely, but the government borrowing rates probably will go negative, which then brings those corporate borrowing rates down close to zero. So you could see an extra wind in the sail just based on the unfortunate debt situation we're in. Everyone's talking about COVID for a long time and what's happening in the markets. We did that for the first 3-4 weeks. But I've quickly moved on to like, what's next? Because we have our game plans. We're already in place. We know what we're doing. I know if A, if B, then C, what to do for clients and how to talk about it and just adjust if necessary. But $2 trillion right off the bat for stimulus, followed by another one, and it's probably going to get to 4 or 5. And then no one is even talking about the deficit next year when tax receipts come in. If you want to call them that, they're going to be a lot. We ran $1 trillion deficit last year in good times. So with this huge drop off in tax receipts, 5, 6, 7 trillion, all of this, starts adding up to real money at some point. And so starting to focus on what are you going to do going forward when the currency debasement is all of a sudden really on the table. It's been talked about for many, many years, but now it's actually a real thing. And so you start asking yourself, how much of my money is in real estate and real assets versus paper assets like currency and stocks? So be prepared for kind of getting through this, which will be a muddle through thing for a couple of years. But the next crisis is looming out there, and we've kind of dragged it forward through this. So really, really important just to like look at your net worth, all of it, liabilities and assets, liquid and non-liquid. Some people just look at their real estate and ignore the other. A lot of people, my job, just look at the stocks and bonds and ignore all the real estate and everything. It's all your net worth, your business, and what are we really facing, not just today, but the next battle as well, and preparing people for that.
I have a question. Keeping up a little bit with the investment in real estate theme, opportunity zone investments have been a hot subject over the last a year, I would say, because on the tax side, it's got a really, really beneficial tax consequence. So if you invest in real estate in an opportunity zone and you hold it for a certain number of years, when you ultimately sell it, you're not going to have any tax on the capital gain. So there has been a lot of investment in a particular space, and I know a lot of those opportunity zones have been rolled into REITs where you can invest in multiple opportunity zone spaces. So what's your opinion, Brian, on that, in terms of, is it generally something that's a good idea? Do you think that this is going to become a little bit of a hotter issue, or there's going to be maybe more opportunity as some of the space is going to, you know, close and the zone will become an opportunity zone. I didn't know if you had any specific opinion on this, and in general,
Sure.
and maybe in light of these particular situations.
So, you know, we've done a couple large deals for clients, which is not me going out and buying real estate for them, right? This is like a professional real estate company doing a couple of buildings in an opportunity zone where a client could take, you know, it used to be you could only 1031 real estate. You know, if I had a building that I've owned for a long time, I could switch it to a similar building and not pay taxes and roll that tax forward. But this is like, even if it's Apple, you know, like you can have any appreciated asset with a big capital gain in it. And then not only are you, not paying the tax now or deferring, but you can even extinguish or remove some of them, which even 1031 doesn't do. If you sell the next one, eventually you have to pay some or all tax on it eventually. Unfortunately, if you didn't do the deals coming into this year, some of the capital gains have gone away. So, I mean, one issue, I think the challenge or headwind in the opportunity zone space is going to be a lot of assets have deflated and repriced. So therefore, the desire to defer or eliminate a capital gain, the market has done that for us, unfortunately, in some areas and in some cases. But not all, and we have a lot of gains built up, right? So I think as long as we don't have, you know, kind of a prolonged downturn where there aren't capital gains to defer for people, it's a great opportunity to move from liquid money into real estate or real asset, or it's less, you know, it's less liquid, but it's now a real asset. Helps with some of the risk management across the portfolio in terms of currency debasement and things like that. Lets us defer taxes, eliminate some eventually. Theoretically do good deeds. You know, the purpose of that legislation was supposed to be to make an impact in blighted areas and places where blighted areas and places that needed the improvement. A lot of them are probably not quite there. I want to caution everyone. I've seen deals go south. You know, there's a lot of complex rules and they're new, right? So not a lot of people are very familiar with them. I've dove into it quite a bit over the past couple of years, and novice at best, because I've seen how intense the rules can be. So sometimes a project will launch, people will put their money into it, but they can't get certain stages done by certain times, and it ends up blowing up the deal. And so you just have to be really cautious about if it's a packaged product kind of a deal versus are you just directly buying a building yourself in an opportunity zone and developing it. I don't know if you guys have seen this, Joanna and Marina, but like the most interesting one to me was like operating businesses in opportunity zones, because then you can actually take a large capital gain. If you were able to buy a business in an opportunity zone, not only the bricks, but something that cash flows as an entity, you're growing that as well from a tax deferred and you know, eventually eliminated portion, you know, so you can really get more leverage off of that move if it's not even just a building.
We are getting a lot of questions with respect to people who are saying, I maybe don't have a financial advisor, or I have one, but I don't know what my strategy is, because, you know, you have your industry has a tendency, like sometimes happens with us, people come to us and whether it's tax or their corporate side, they're like, well, I just trust you. So they do what we tell them, and then they don't really stay engaged with it. So sometimes some of the people I've talked to have said, well, I'm kind of embarrassed because I don't know what you mean if I'm in equities and if I should be. And so is it too late? I guess what I'm saying is people are asking, have I missed the bus?
Yeah.
If I didn't do this before this started, is it worth it now? Or is it too far gone to salvage what is left? Because people are concerned. I'm looking at my 401k statement and it's a lot lower, and should I just sit tight or hide under the bed, or what do I do?
Yeah, it's a great question. I guess first and foremost, it's the opposite of too late. Like, it's actually a sense of urgency. The whole, like, just like when I hear this all the time, like people are saying, just sit tight. Just sit tight is not an effective strategy. It doesn't mean panic and sell. We don't do that either, but just sit tight. The world is completely shifted. And to not shift based on that alone is kind of crazy. You know, hope it all comes back. You know, hope is not a strategy either. What you need to do is, you know, take action, and it can be done not in a panicking way. Right now, the reason why I say there's urgency is we've had a massive bounce off the bottom. So you get a second chance right now to do what arguably should have been done initially. But that can melt away within a week or 2 or 3. We saw how fast the markets move when they move the other way. But right now, if you get an assessment, goals, how are you set up? Does it match or not? If no, you have a great opportunity to either tweak it right now or create a plan over time to tweak it in time so we get a smooth answer. And do you have the right stuff for each bucket, or do you have stuff that, you know, you probably don't really want to be in right now? And the bad stuff bounced pretty good too. It's still way down, but you have an opportunity right now that is just like when this first started. The first week of this, I think I talked to a bunch, Joanne Marina, during that. I was out in Vegas during that Forbes conference, and I'm like, this is happening, right? Like, and no one was really talking about it yet, but it was happening. And so you had a chance then to start doing it. Most people didn't, but now you have a second chance. You know, the NASDAQ just popped positive for the year, as an example, meaning just to show you how far the recovery has been. You know, so a lot of energy and airline stuff's down 70, 80% still, but like the core investment out there, a lot of them are either up for the year or only down 10% or 15%. This is a chance to recharacterize the portfolio to the right kind of things, to reassess risk. And I know there is a lot of jargon in there for people saying this, I run my business, I don't want to think about this. Financial advisors, unfortunately, right, you know, there's 250,000 of us, and the bar to entry is not that high, right? It's one test. So there's not a lot. So, you know, you saw some of the designations I personally have. I mean, like, I obviously take this very seriously. And there are, you know, the top 10% or maybe 5 or even 1% of financial advisors take their job very seriously. That bell-shaped curve does apply everywhere. You know, lawyers and CPAs, you guys actually have to go to school and a lot and be very smart. Financial
and it's still a low bar to entry.
And there's still a bell curve.
The curve applies everywhere. You know, I just tell people, if I'm going to get brain surgery, I don't want the average brain surgeon. I certainly don't want a below average one. I want someone on that right tail of the curve. And when it comes to your retirement and your money, like, it's the same thing. Take it seriously. Just look who you're dealing with. What are their credentials? What are their recognitions? And is there a match with their process and yours? We certainly, you know, could help anyone that is interested, and also refer anyone to someone. I mean, we know who the best of the best in this business are that actually take this very seriously, and do this as a professional trade and not just a mutual fund sales organization of some kind.
That's one thing I can attest for personally. We've sent Brian lots of clients who have had unique individual needs. And every single time that I've called to say, hey, my client is affected by this, or concerned about this, or interested in this, do you know anybody? And he's like, there's a guy in Philadelphia, there's a guy in New Orleans, there's a guy in Ogden, Utah. And you always, you know, like a good Northeasterner, you always have a guy. There's always a guy. So I've appreciated that personally and professionally, and you've always taken good care of our folks. So if anybody has any last minute questions, we will field those, but we want to make sure we get Brian back to work, because this market is bouncing around like a ping pong table. So we don't want to keep you too long. I think that is.
I think we're good.
I think we're good. I don't see anything else. I want to remind everybody that our webinars are recorded. They will be distributed to you via email. They will be time-stamped and beautifully indexed on YouTube. They'll be on our Facebook pages, and also on the Koontz & Associates and Koontz & Parkin websites. If you need to reach Brian, I can get you his details as well. They're here on the slide, and also we will have them provided to you. Thank you for watching. You have a great day. Be safe. We will be chatting with you next Tuesday with Christine Sensenig, our labor and employment attorney, who's coming with the update with respect to what's going on with unemployment. There's been a ton of talk and a lot of updates since she was on with us last. In the meantime, I know that a lot of you are concerned about what's going on with your PPP loan forgiveness. We are still awaiting additional guidance. We did get some additional Q&As last night, and we're waiting on more. One thing we got confirmation of is that they have said they will be giving us more Q&As and more guidance on the debt forgiveness piece. So I expect that to be coming. If we get something that is urgent and important, we'll do a pop-up webinar, so look for that. If not, if it comes at a trickle speed, we will be covering that next Thursday. So stay tuned.
The one thing I did want to mention before we go today is the couple of things that did come out yesterday. There was a big question on, again, can I postpone using my funds? Can I postpone the start of the 8-week testing period if I am still closed? So it's nice that I have all my money now, thank you, but if I'm not open or half of my employees are not working, let's say I'm a restaurant, and now my testing period begins, can I postpone that to the time that I'm open? At this time, they said no. At this time, you cannot even postpone taking the money from the bank. So even if you got a confirmation that you have been approved for the loan, the bank is obligated to get you the funds within 10 days. And from the day that the funds drop, your 8-week testing period starts. This is as of right now. So you cannot even call the bank and say, hold on to the money for me and give it to me a month from now. That is not possible at the moment. And then the only other update that I did want to mention, last week, Jackie and I spoke about what is economic uncertainty, are the funds necessary, and all of that certification that a lot of people had to think twice about when they applied for the loan, and whether that does apply to them and whether they really shouldn't be taking the loan and need to give the money back. As Jackie and I mentioned last week, SBA gave everybody up to May 7th to give the money back if you thought that you were really not taking the loan properly. They have extended that to May 14th. So the new deadline is May 14th. And remember, that's a deadline for you. It's a safe harbor deadline where if you feel like you have taken this loan and you really did not have economic uncertainty and you didn't have really the need for this loan, you can give the money back before May 14th without you being questioned or audited or investigated or anything like that. So those are the two kind of main things that have come out yesterday. And so I'm fielding a lot of emails about, I have my funds, now what? I got my money, what do I do with it? How can I get this forgiven and all that stuff? So just to reiterate, the forgiveness is not going to be automatic. You're going to have to apply for it. And that is exactly what we're waiting on, is some guidance on what that application is going to look like, what particular things are allowed and not. The other big chunk of emails relating to the forgiveness that I'm getting is on the self-employment individuals, is to say, we know mortgage interest and utilities or rent are allowed as part of the allowed expenses under this loan. So is that okay? Can I pay my personal mortgage if I'm self-employed and I'm working from home? Again, we do not know 100%, but based on everything I've read, I would venture to say at this moment that although a home office deduction is an allowed deduction for tax purposes, the part of your house and part of the mortgage interest is not going to be an allowed expense for purposes of the debt forgiveness. Again, more guidance is coming, but this is what our thought is at the moment from everything that we know. So please hang tight. Those folks that have gotten their money, we will bring you more forgiveness guidance as it comes. It's most certainly a hot subject now. At this moment, we just say document how you're using the funds, and segregate them in a separate account if possible. And if not possible, the more documentation you have, the better.
And to tail on top of that, to be as regular as you have been. Like, don't do anything outside the ordinary course of business. We've had a lot of folks saying like, well, maybe I should hurry up and bonus this person or give this person a raise or do something drastically different. Just be as routine as you possibly can. That's going to help defend any position that we end up taking. It's going to put you in the best light to support that if it's usual and customary. If you typically, like tax season, for example, if you typically bonus folks at the end of tax season and now is time to give the bonus, give the bonus. But if you never have given a bonus in May before, now is not the time to run out and start helicoptering your own money and giving people bonuses. You want to do everything as routine as you possibly can in the middle of this complete upheaval of the business where nothing is routine. We want to see those financial expenditures be as reasonable and ordinary as possible. So I would say when it comes time to, because especially we haven't gotten the guidance, I've had some people saying, I've had my money 10 days, 14 days. Now I'm getting worried because a fourth of my testing period is gone and I still don't know anything about how to spend the money. I promise those answers are coming. Now is not the time to go panic spending and doing crazy stuff, because that will be hard to undo now that they're tracking where the money is going. If we run out of time and we need to do something later and rules make flexibility for those changes, we'll do it as it comes. But just be patient and be vigilant. We'll be with you as soon as we get more guidance. All right. Anything else, Brian? Parting thoughts?
No, thank you so much.
Thank you. Thanks for being with us. Marina, thank you. Everybody stay healthy and have a great weekend. We'll see you Tuesday.